AI for stock market. Can artificial intelligence predict prices? A comprehensive analysis of algorithmic forecasting in 2026. Abstract. The quest to predict stock market movements has transitioned from human intuition and simple linear regression to the complex realm of artificial intelligence, AI. In the current financial landscape of 2026, deep learning, DL, reinforcement learning, RL, and large language models, LLMs, have redefined market efficiency. This article explores the mechanisms of AI in finance, the validity of its predictive power, the inherent limitations of algorithmic trading, and the future of the man-machine synergy in wealth management. 1. Introduction. The evolution of market analysis. For decades, the financial world was governed by two main schools of thought: fundamental analysis and technical analysis. However, the sheer velocity, variety, and volume of data in the 2020s rendered traditional methods insufficient. Entering 2026, the stock market is no longer just a reflection of company earnings. It is a digital ecosystem where trillions of data points are generated every second. Artificial intelligence has emerged not merely as a tool, but as the primary infrastructure of modern finance. The central question, can AI predict prices, has evolved into, to what degree of accuracy and over what time horizon can AI maintain a competitive edge? 2. The technological architecture of modern AI prediction. To understand if AI can predict prices, we must first examine the engine under the hood. 2.1. Recurrent neural networks, RNN, and LSTM traditional neural networks fail at time series data because they lack memory. Long short-term memory. LSTM networks change this by allowing the model to remember significant price fluctuations from years ago while discarding noise. In 2026, LSTMs are used to identify cyclical patterns in volatile markets like cryptocurrencies and tech stocks. 2.2. Generative Pre-trained Transformers, GPT, in finance beyond chat interfaces. Transformer architectures are now used to process financial sequences. By treating price movements like words in a sentence, transformers can predict the next word, the next price move, based on the context of global economic shifts. 2.3. Reinforcement learning, RL, the trial and error genius. Unlike supervised learning, RL agents do not just predict, they act. They trade in simulated environments millions of times, learning which strategies maximize cumulative rewards, alpha. These agents are the backbone of modern high-frequency trading, HFT. 3. Data sources, beyond the price chart. The predictive power of AI is only as good as its data. In 2026, alternative data has become the primary battleground. Satellite imagery. AI analyzes the number of cars in retail parking lots or the movement of oil tankers to predict quarterly earnings before they are announced. Natural language processing, NLP. Modern AI scans 50,000 plus news articles and millions of social media posts, ex-Reddit, per minute to calculate a fear and greed index in real time. Supply chain logs. By tracking micro-movements in global logistics, AI predicts which industries will face inflationary pressure weeks before the CPI data is released. 4. The challenges. Why AI is not a crystal ball. Despite its immense power, AI faces fundamental hurdles that prevent 100% accuracy. 4.1. The efficient market hypothesis, EMH. The EMH suggests that if an AI discovers a predictable pattern, it will immediately exploit it. As a result, the pattern disappears. In 2026, this arbitrage decay happens in milliseconds. AI isn't just fighting the market, it's fighting other AIs. 4.2. Overfitting and the noise problem. Financial data is notoriously noisy. A model might find a perfect correlation between the weather in Brazil and the price of Apple stock by pure coincidence. This is known as overfitting. When the model meets a real-world scenario, its predictions collapse. 4.3. Black swan events and out-of-distribution data AI is trained on the past. When a unique event occurs, a global conflict, a new type of financial crisis, or a breakthrough in quantum computing, the AI has no reference point. These black swan events remain the Achilles heel of algorithmic prediction. 5. Ethical and systematic risks. The rise of AI in stock markets introduces new risks. Flash crashes. When multiple algorithms react to the same signal, they can create a downward spiral, wiping out billions in seconds. Market manipulation. AI can be used to create fake signals, spoofing, to trick other algorithms. The black box problem. If an AI loses $1 billion, can we explain why it made that decision? In 2026, explainable AI, XAI, is a major regulatory requirement to prevent unidentifiable systemic failures. 6. The 2026 perspective, the hybrid future. The most successful firms of 2026, Goldman Sachs, BlackRock, and boutique quanti funds, have realized that pure AI is risky. The winning formula is centaur trading. AI handles the data crunching, pattern recognition, and execution. Human analysts handle the big picture strategy, ethical considerations, and what-if scenarios. 7. Conclusion. Can AI predict prices? The answer is a nuanced yes, but with a caveat. AI can predict statistical probabilities, not certainties. It can tell you that there is a 62% chance of a stock rising in the next 10 minutes, based on current liquidity and sentiment. However, it cannot account for the human element of a sudden psychological shift in the masses. As we move deeper into 2026, the edge belongs not to those with the fastest AI, but to those with the best integrated AI systems that understand the limits of their own intelligence. Not bumetin makalenin ana iskeletini vederin lemesina teknik detailarini ikermektedir. Eger bu makalei bir blogda veya akademik bir kalismada kulana kaksanis. Her bir baslik altina. Ornigen, LSTM modelarinin, matematiksel formulary HTS, HT1 plus WXXT plus B. Gibi, teknik eklemeler yaparak metni daha da genişletebiliriz. 8. Deep Dive, the mathematical and algorithmic core. To appreciate the predictive power of AI, we must look at the mathematical frameworks that allow machines to simulate financial intuition. 8.1. Time series analysis and the vanishing gradient problem standard. Neural networks struggle with stock data because they treat each day as an independent event. However, stock prices are path-dependent. The price of a stock today is intrinsically linked to its price yesterday. In 2026, the use of gated recurrent units, GRUs, and LSTMs has solved the vanishing gradient problem, where models used to forget the beginning of a long data sequence. These models use a forget gate to decide which historical information, like a 2008-style crash pattern, is still relevant and which noise should be discarded. 8.2. Multi-agent reinforcement learning, MARL. The stock market is not a static environment. It is a game played by millions. 2026 marks the rise of multi-agent reinforcement learning, MARL. In this setup, an AI agent isn't just trying to predict the price. It is trying to predict how other AI agents will react. Zero-sum dynamics. AI learns that for it to buy at a low price, another entity must be willing to sell. Liquidity provision. High-frequency AI agents now act as market makers, providing liquidity while simultaneously extracting tiny fractions of a cent from millions of trades. 9. The Data Revolution. Alternative Alpha in 2026. Traditional data, OHLC, open, high, low, close, is now considered exhaust data. It is useful, but everyone has it. To gain an edge, AI systems in 2026 ingest alternative data at a scale previously unimaginable. 9.1. Natural Language Understanding, NLU, at scale. Modern LLMs, large language models, specifically tuned for finance, can read a 200-page earnings call transcript in 0.5 seconds. They don't just look for keywords like growth or profit. They analyze the hesitation in a CEO's voice via audio-to-text sentiment, or the subtle shift in vocabulary that might suggest hidden liabilities. 9.2. Geopolitical and environmental data. AI models now integrate real-time climate data to predict commodity prices. For example, agricultural yields. AI analyzes soil moisture sensors and satellite spectral images to predict corn or wheat futures weeks before government reports. Energy consumption. Real-time thermal imaging of industrial zones allows AI to estimate a country's manufacturing output before official GDP figures are released. 10. Risk management. The algorithmic defense prediction is only half the battle. The other half is not losing money when the prediction is wrong. 10.1. Dynamic position sizing. AI uses the Kelly criterion or Bayesian inference to adjust how much capital to risk on a single trade. If the AI's confidence score in a prediction is 70%, it might allocate 5% of the portfolio. If the confidence drops to 51%, it might only allocate 0.5%. 10.2. Automated stop loss and volatility harvesting. In the volatile markets of 2026, AI manages risk by harvesting volatility. Instead of a simple stop loss, AI uses vol surface modeling to predict when a dip is a buying opportunity and when it is the start of a regime change, a long-term trend reversal. 11. Ethical considerations and the black box problem. As we rely more on AI, the black box problem becomes a systemic risk. If an algorithm decides to sell off an entire sector and we don't know why, it can lead to flash crashes. Explainable AI, XAI. There is a growing movement in 2026 to force financial AIs to provide a reasoning path. Regulators now demand that for every $1 million trade, the AI must be able to highlight which data points, for example, a specific tweet plus a specific interest rate move, triggered the action. Bias in training. If an AI is trained only on a bull market, rising prices, it will be dangerously biased toward buying. Ensuring global regime training is essential for long-term survival. 12. Conclusion. The democratization of AI trading. In the past, only hedge funds like Renaissance Technologies had these tools. In 2026, retail investors have access to Copilot AIs that offer institutional-grade analysis. Can AI predict prices? Yes, but it is an arms race. As soon as one AI finds a way to predict the future, the market adjusts and the future changes. The prediction is not a destination, but a continuous process of adaptation. 13. Case studies. AI's performance in the real world. 2020 to 2026. To answer whether AI can predict prices, we must look at how it has actually performed during periods of extreme market stress. These case studies highlight the strengths and catastrophic failures of algorithmic systems. 13.1. The 2020 pandemic crash, a failure of historical data. When the COVID-19 pandemic struck, most AI models failed. Why? Because the training data, historical sets from 2000 to 2019, did not contain a global lockdown scenario. The issue: models interpreted the sudden drop in travel and oil demand as a standard cyclical downturn rather than a systemic halt. The lesson: this event proved that AI is inherently conservative. It expects the future to look like the past. Models that survived were those with human-in-the-loop overrides, where managers manually deleveraged portfolios before the algorithms could spiral. 13.2. The 2021 meme stock phenomenon, NLP to the rescue. The GameStop, GME, and AMC short squeezes of 2021 were a turning point for sentiment analysis AI. Traditional models looked at debt-to-equity ratios and saw a failing company. However, newer NLP, natural language processing models, were scanning Reddit's Wall Street bets. The success quants who integrated social media sentiment into their AI were able to detect an anomalous spike in retail conviction. These models predicted the squeeze not by looking at the company's value, but by measuring the velocity of social coordination. The 2026 evolution. Today, this is called social arbitrage. AI now monitors millions of Discord servers and Telegram groups to predict where the next crowd-driven move will occur. 13.3. The 2024 Flash Recovery and Machine Coordination. In early 2024, a brief geopolitical scare caused a 4% drop in the S&P 500 within minutes. While human traders panicked, mean reversion algorithms identified that the selling was purely algorithmic and not based on fundamental changes. The outcome: automated buy-the-dip programs triggered simultaneously across major hedge funds, leading to the fastest recovery in market history. This demonstrated that AI can actually stabilize markets by identifying oversold conditions faster than any human could. 14. Comparative analysis, AI versus the human fund manager. 15. The arms race and the future of alpha. If everyone uses the same AI, does the advantage disappear? This is the paradox of alpha decay, hardware supremacy. In 2026, the battle has shifted to hardware. Firms are investing in optical computing and quantum-inspired chips to run Monte Carlo simulations 1,000x faster than competitors. Data exclusivity. Since everyone has access to the same news, the winners are those who find dark data. Private logistics records, proprietary IoT sensor feeds, and encrypted blockchain flow analysis. Adversarial AI. We are now seeing the rise of generative adversarial networks, GANs, in trading. One AI creates a trading strategy, while another AI, the adversary, tries to find the flaws in it. This self-play evolution makes the models incredibly robust before they ever touch real money. 16. Final synthesis. Can AI predict prices? We conclude that the term predict is often misunderstood. AI cannot tell you that Tesla will be $452.12 on Friday. However, it can tell you that, based on 14.2 million variables, there is a 64% probability that Tesla will trade higher in the next 4 hours with a projected volatility of 1.2%. Artificial intelligence has transformed the stock market from a game of opinions into a game of probabilities. In 2026, the most successful investors are not those who beat the machine, but those who build the most transparent, ethical, and data-rich machines. Conclusion. As we look toward 2030, the integration of quantum computing and AI will likely be the next frontier. The ability to simulate every possible market outcome simultaneously will bring us closer to prediction than ever before. But for now, AI remains the ultimate co-pilot, a tool that sees what we cannot, processes what we won't, and acts when we hesitate.